On June 16th, a sudden, localized flash crash wiped out millions of dollars of capital in an instant. This liquidation heat map captures the sudden market wipeout, where over $56 million in notional leverage evaporated in a single 4-hour window. At block height 950,000, network fundamentals were stable. Hash rate was steady, and block space demand remained within normal parameters. To track these real-time data shifts before they execute, make sure to subscribe to the channel. Localized flash crashes expose the limitations of traditional fundamental analysis. When on-chain metrics suggest a healthy network, they often overlook the mechanical traps built into the derivatives market. This diagram contrasts public and hidden market data. Public metrics present a calm surface, while the underlying derivative order book reveals a much more volatile landscape. Currently, billions of dollars in institutional capital are positioned based on standard risk models that fail to track exactly where leverage is concentrated. This movement is driven by liquidation magnetism, a process where the market mathematically targets zones of high leverage. This mid-June heat map illustrates the effect. Where liquidity is absent, price is pulled toward high-density zones elsewhere on the chart. Traders ignoring these heat maps fly blind. Empty zones offer no organic support, forcing price to move until it finds liquidity. Market volatility functions as a mechanical process designed to clear over-leveraged order books. To trace the engineering of the June 16th trap, we have to look at the market's baseline state on June 12th. On June 12th, price action was isolated between $63,000 and $64,000, lacking organic support. The dark purple areas indicate dead space, an absence of active order flow. Meanwhile, a massive algorithmic floor formed at $63,000, visible as a thick yellow band preventing downward drift. These bright bands, or notional leverage clusters, represent trapped capital, zones where thousands of highly leveraged positions are sitting side by side. As the day progressed, retail traders began stacking limit orders at $64,000, operating on the assumption that a bullish breakout was underway. When short positions cluster too tightly against a rigid algorithmic floor, it builds mechanical pressure that can only be released upward. This pressure resulted in the sharp vertical price wick seen here, contained entirely within the $63,000 to $65,000 range. If you find this granular heat map analysis useful, please like and share the video. The push to $65,000 was fueled by the kinetic energy of a localized short squeeze rather than organic spot buying. By June 13th and 14th, the market entered a period of calm but allowed the algorithmic strike to be organized. Following the squeeze, retail sentiment became bullish. Traders expected a continuation based on the recent price action and stable network demand. The derivative data indicated a different reality. Thick yellow and green bands formed between $64,000 and $65,000, revealing extreme vulnerability. These bands represent a dense concentration of over-leveraged long positions, sitting just beneath the current support level. Automated trading algorithms constantly scan these order books and identify these dense pools as high-value targets for extraction. This temporal gap in the heat map data shows a window where positioning is hidden from view, a common occurrence during leverage transitions. In this blind spot, the asset is mathematically drawn toward the largest trapped positions. A final surge toward $66,000 successfully lured in a wave of late retail long positions. This clustering around the peak represents the final concentration of trapped long leverage. Breakouts are frequently the result of the market mechanism dragging the price up to engineer a more lucrative liquidation pool below. On June 16th, after days of mounting pressure in the market, the accumulated leverage finally reached a breaking point. Right before the crash, the price hovered dangerously above the target zone, oscillating between $66,000 and $67,000. The precision of this drop identifies it as a targeted algorithmic strike, prioritizing specific mathematical price points over a broad market exit. This movement is a liquidation sweep, which functions as the primary driver behind this type of localized price volatility. The price wick on this heat map drops and hits its target with extreme accuracy. At $65,200, it collides with the densest liquidity block. The algorithm consumes this yellow band, clan positions. Instantly, the cascade halts, resulting in a V-shaped recovery. This action is rapid and stops the moment the target liquidity is secured, differing significantly from the more erratic nature of retail panic. To catch these intra-week reversals as they happen, subscribe for our weekly updates. These localized flash crashes function as surgical maneuvers to clear leverage, occurring in isolation from the asset's network fundamentals. This wide heat map summarizes the week's structural shift. The capital flush cleared lower bands, resetting the board. Now the highest trapped capital concentration sits above, at $67,500. Below the current price, the heat map shows a total lack of resistance. Direction over the next 7 days depends on whether organic spot volume can outpace the upward magnetism of the remaining derivative cluster. Follow us on Twitter for real-time updates as new clusters form. Price strictly follows liquidity. Master the heat map and you master the market's true direction.